Hi there, welcome to our Q1 2023 webcast. We have an action-packed agenda for the start of 2023. We'll be covering new amendments and standards that are effective in 2023, as well as looking at some hot topics and having a bit of a spotlight on tax. I'm Gary Berkowitz, and today I'm joined by my fellow presenters, Marie Kling, Lynn James, and Scott Bandura. We hope you enjoy.
So what are the new accounting standards and amendments that are effective for the first time in 2023? The only new accounting standard that is effective for the first time this year is IFRS 17, the new accounting standard on accounting for insurance contracts. The current standard, IFRS 4, permits a wide variety of practices in accounting for insurance contracts. IFRS 17 will fundamentally change the accounting practices for all entities accounting for insurance contracts and investment contracts with discretionary participation features. Some insurers may also be applying IFRS 9 for the first time at the same time they apply IFRS 17. And of course, IFRS 17 does not only apply to entities in the insurance industry. We have published an in-depth which sets out some of the key reminders for non-insurers. Other than IFRS 17, there are three new amendments that are applicable for reporting periods beginning on or after 1 January 2023. The first amendment relates to the definition of accounting estimates and amends IAS 8. The amendments introduced a definition for accounting estimates and also made other amendments to help entities distinguish between changes that are changes in an accounting estimate and those that are change in accounting policy. This distinction is important because changes in accounting estimates are counted prospectively to future transactions and other future events, whereas changes in accounting policies are generally accounted for retrospectively and apply to past transactions and past events as well as the current period. The IASB also amended IAS 1 to require entities to disclose material rather than significant accounting policy information. The amendments define what is material accounting policy information, and they provide guidance on how to identify when accounting policy information is material. They also clarify that an entity does not need to disclose immaterial accounting policies, but if they choose to do so, they should make sure that it does not obscure material accounting policy information. To support the amendments, the IASB also amended Practice Statement Number 2, Making Materiality Judgments, to help provide guidance on how to apply the concept of materiality to accounting policies. The key takeaway is that entities might want to carefully consider what accounting policies they disclose and what those policies say in their 2023 financial statements. We have also issued a practice aid to help provide examples of how this may be applied in practice. The last amendment relates to deferred tax on assets and liabilities arising from a single transaction and amends IAS 12. In terms of the amendment, an entity is required to recognize deferred tax for transactions that on initial recognition give rise to equal amounts of deductible and taxable temporary differences. The amendments may have a significant impact for entities that have substantial amounts of things like right-of-use assets, lease liabilities, decommissioning, restoration, and similar other obligations. The impact of this amendment is that an entity is now required to recognize deferred tax assets and liabilities. Some entities may be already applying their requirements of IAS 12 consistent with these amendments, and therefore they will not be impacted by these recent amendments. We have issued an in-brief which provides further details on this amendment. Entities will need to consider the impacts of IFRS 17 and IFRS 9 for insurers applying it for the first time, as well as the impact of the new amendments on their 2023 interim financial statements. Unlike some other new accounting standards, IFRS 17 and IFRS 9 did not amend IAS 34, the accounting standard on interim financial statements, to bring in new disclosure requirements specific to these standards. The general requirements in IAS 34 will therefore need to be applied to these amendments and new standard. So what is the general requirements? The general requirement requires that when a new standard or amendment is adopted in an interim period, an entity disclose discloses a description of the nature and effects of those changes on accounting policies and methods as an update to what was last disclosed in the annual set of financial statements. The extent of these disclosures will depend on the amendment or standard that's been adopted, as well as the relevance and significance to the entity. These disclosures will likely vary between entities depending on qualitative and quantitative factors, and we expect entities to apply judgments in determining the appropriate level of disclosure to provide. It is important to remember the primary intention behind IAS 34 is to provide an update from the last set of annual financial statements, and therefore these disclosures should focus on significant events, circumstances, and activities since the last set of financial statements. If you would like further detail on this, we have put together an in-depth which sets out some of the considerations related to applying IFRS 17 for the first time in a 2023 interim set of financial statements. In the first set of annual financial statements that an entity applies IFRS 17 and the new amendments, entities should bear in mind that IAS 8 provides specific disclosure requirements related to changes in accounting policies that arise from the initial application of a new accounting standard that affects either the current period or prior periods or might affect future periods. Luckily, there is good news from an IFRS 17 perspective, and IFRS 17 has introduced an exemption that does not require the disclosure in paragraph 28F of IAS 8. That is, disclosure of the amount of the impact in the current period in each of the prior periods presented for each financial statement line item affected is not required to be disclosed.
Right, so in terms of hyperinflationary economies, you'll see the list on the left there highlights the economies that have been hyperinflationary for a while. What's new to the list as at 31 March 2023 is Haiti. Haiti became hyperinflationary at the beginning of this year, and so it will be included from a hyperinflationary perspective, and IAS 29 will need to be applied if you have operations in Haiti. You may recall that towards the end of last year, we also mentioned Sri Lanka, and that was going very close to becoming hyperinflationary towards the end of last year. The good news is that due to the intervention by regulators in Sri Lanka, the inflation numbers are actually coming down slightly from where they were towards the end of last year. And so the good news is Sri Lanka is not hyperinflationary at 31 March, but remains on the watch list.
Supplier finance arrangements have been a key topic in the last couple of years. And you may actually recall that we've covered this area in some of our previous webcasts. However, since then, the IASB has worked on amendments to IAS 7 and IFRS 7 to include new disclosure requirements. And this is actually in response to feedback received from users. Users of the financial statements found the current disclosures to be insufficient in order to assess the use of these arrangements by entities. But you're probably wondering, why are we talking about this now? Well, the punchline is, these amendments will be published during Q2 2023. And the key highlight is that the IASB has decided that the effective date for these amendments will actually be January 1st, 2024, with early adoption permitted. The effective date is therefore accelerated compared to the typical time frame we see for other standards. So this is coming up rather quickly, and entities should start focusing on these arrangements now in order to be ready for those new disclosure requirements. The amendments will require entities to disclose information on the effects that supplier finance arrangements have on their liabilities and cash flows, as well as their exposure to the liquidity risk. There are also some good news. Some reliefs will be provided for the first year of application. And this is really done so to assist preparers in gathering all the necessary information. Another important consideration is that the disclosures will only be applicable for annual periods and not interim periods in this first year of adoption. But let's take a look at the nature of these arrangements. First, it's key to understand what arrangements fall in the scope of the disclosures. The IASB has decided not to provide a definition of these arrangements because of their evolving nature. However, what we expect is that key characteristics and examples will be included in the amendments. Now, generally, these arrangements involve three parties. There's a supplier who supplies the goods, a buyer, and a financial institution, which is often a bank. Now, the bank offers to pay amounts the entity owes to its suppliers, and the entity agrees to pay the bank in accordance with the contractual provisions of the arrangements at the same date or at a later date than when the suppliers are paid. These arrangements usually provide the entity with extended payment terms or the entity suppliers with early payment terms compared to the related invoice payment due date. Now, these arrangements are labeled in different ways in practice, so they may be referred to as supplier chain finance, payables finance, or reverse factoring arrangements. But let's take a look at some of these specific disclosure requirements that will be introduced in the amendments to IAS 7 and IFRS 7. The first requirement is to disclose the terms and conditions of the supplier finance arrangements, including, for example, extended payment terms and any security or guarantees provided. Now, if the terms and conditions of individual arrangements are not similar, the entity should disclose the unique and unusual terms and conditions for those individual arrangements. The second requirement deals with quantitative disclosures. Now, these include the carrying amounts of those financial liabilities that are part of supplier finance arrangements and where they're presented in the statement of financial position. The amount of those liabilities for which suppliers have already received payment from finance providers. And lastly, the range of payment due dates for both the financial liabilities that are part of supplier finance arrangements and comparable trade payables that are not part of such arrangements. Now, these last two quantitative disclosure requirements do not need to be provided at the beginning of the annual periods of the first year of application. So for a calendar year and company, these last two disclosures do not have to be provided as of January 1st, 2024. Lastly, these amendments will reinforce that supplier finance arrangements are an example to be considered in IFRS 7 when disclosing liquidity risk. So what's the key takeaway from all this? Well, because there's a short period of time between the release of these amendments and their effective date, we would recommend to start the process early and gather all the information that will be needed for the disclosures. Some of these new disclosure requirements may trigger the need for entities to engage with the financing entity to get new information, in particular for the requirement to disclose those liabilities for which suppliers have already received payments from the financing entity. In some cases, contractual arrangements with the financing entity may even need to be amended to specifically cover that information. So it's really key to start early and make sure you're ready when the disclosure requirements are effective.
With the increasing focus on climate change, many companies are taking steps to reduce or offset their carbon emissions. Complete elimination of carbon emissions through operational mitigation methods is not always possible, and this drives demand for carbon offsets, also known as carbon credits, to offset all or a part of the remaining emissions generated by an entity's operations or in its value chain. A carbon credit is an emission unit that represents an emission reduction or removal of 1 metric ton of CO2 or an equivalent amount of other greenhouse gases. The voluntary carbon market is growing, and therefore consistent accounting practices for carbon offsets are becoming more relevant for many companies, including those that are using carbon offsets in their climate goals, who are developing projects to generate them, or who trade or invest in carbon offsets. There are no accounting standards or IFRS interpretations that directly address the accounting for voluntary carbon offsets and related projects, and therefore we recently issued an in-depth IFRS financial reporting considerations for entities participating in the voluntary carbon market that provides practical considerations for companies in accounting for carbon credits. This publication considers the accounting for such arrangements for the various participants in the market, and new topics and considerations continue to arise as the market continues to evolve and will likely continue to expand this guidance as new issues emerge. The topics included in the initial in-depth include a background of carbon markets, discussion of the accounting principles for offsets on hand and for buyers of such credits, as well as accounting considerations for project developers. We hope that you'll find the in-depth to be useful in considering the accounting for participants in the voluntary carbon market, and also useful in sparking further discussions.
Right, what update wouldn't be complete without a discussion on taxes? And the first one we want to talk about is the OECD's new global minimum taxes, referred to as GLOBE rules or the Pillar 2 rules. Just a bit of background. We have spoken about this a couple of times, but just to briefly remind folks, Pillar 2 rules basically establish a global minimum tax of 15% for some large multinational entities. The way it worked was that the OECD, which is a non-for-profit, put in place a framework, and it is up to individual jurisdictions to actually enact these rules within their local legislation. So it's only when it becomes enacted locally that it will take effect. Now, once the rules come into effect, there's questions, I guess, from an accounting perspective in terms of the difficulties in calculating and thinking about deferred tax and the usefulness of that number. And as I say, that was very, very brief. We spoke about this in quite a bit more detail in our Q4 2022 webcast. So if you need a little bit more detail, you're welcome to go back and have a look at that. But what's happened since then is really what we wanted to focus on here. And there's been a couple of things. The one is that the ISB is proposing a temporary exception to the accounting for deferred tax that relates to anything that arises as a result of this Pillar 2 legislation when it's enacted. And you'll see on the bottom there, in terms of the timeline, that exposure draft was issued on the 9th of January 2023. The comment letter period closes on the 10th of March. And we're expecting the ISB to move very quickly to issuing a final amendment to IS-12 after the comment period closes, provided they don't get a huge amount of pushback, which we're not expecting. We're expecting everyone to be very supportive of this initiative, and the ISB has moved very quickly in response to folks saying they really need an exception before the rules are enacted in their local territory so that they can get the exception from applying deferred tax to any of the Pillar 2 implications. So as I mentioned on the previous slide, we are not expecting a huge amount of pushback to this proposed exception. And on the slide, we cover, I guess, some of the key points from a PwC perspective that we are commenting on or did comment on the exposure draft. I think the one was just general agreement with this exception. I think we agree that the difficulty, the question of whether or not you should even be recognizing deferred tax and the usefulness of the information that would come out all lead one to say it doesn't really make sense to recognize any deferred tax related to this. And so we are very supportive of the exception, and we think we should move as quickly, or the ISB should move as quickly as possible to get that exception out, because, as we've said on the slide, certain jurisdictions, it's imminent that they will actually enact the Pillar 2 requirements, which is what triggers this question around deferred tax. A couple of observations on the scope of the proposals that we raised. I guess the one is that the proposals scope out all qualifying domestic minimum top-up taxes as well. And I think in some cases, depending on how that is defined, because it's not totally clear, judgment might need to be applied to determine whether or not something actually is a qualifying domestic minimum top-up tax from a Pillar 2 perspective. Because if it is, you do not have to, or you're precluded from recognizing any deferred tax. But if it isn't, then you would need to worry about recognizing any deferred tax implications. So it actually makes quite a big difference if you decide something is a qualifying domestic minimum top-up tax, or QDMT. Another thing that I think we would probably be looking for a little bit of clarity on is in the separate financial statements. Obviously, this was focused on consolidated, but from a separates perspective, it would be good if it clarified which entity in the group or entities in the group should recognize the expense related to the top-up tax, the current tax that that one or more of the entities in the group might need to pay once Pillar 2 becomes effective. And the last thing is then there's a lot of disclosures, and I know folks everyone has their bugbears on the disclosures. So there's a number of disclosures that the ISB proposed, because they said, look, if we're going to put an exception into potential recognition of deferred tax here, we really need to make sure there's not an informational loss to investors. And as a result, there's a couple of disclosure proposals in there. I think there's a trade-off here, and as I said in the slide, I think we think speed is preferable to perfection here. But again, some of the disclosures, for example, disclosing the average effective tax rate, ETR, applying IS-12 in your jurisdictions, and disclosing which ones are below 15% to give an investor maybe an idea of when you might be subject to Pillar 2. We think in many cases, because the Pillar 2 requirements are very different in some cases from the way you calculate your tax under IS-12, we're not sure that will really be that helpful. But as I said, everyone has their bugbears on the disclosures. I think at the end of the day, it would be fine putting them out with no changes, provided that the exception comes out as soon as possible. That's at least our view. And then finally, with respect to Pillar 2, the big issue that is one that folks are just coming to terms with now is the challenges that get included as a result of endorsement. And I think on the slide, we've tried to demonstrate that with a timeline. So assume your Pillar 2 legislation is enacted in a particular jurisdiction. You've got your reporting date, and then sometime in that slide there as well, the ISB exception would be issued. However, there then is a delay in terms of your local jurisdiction actually endorsing the exception that clarifies that you shall not recognize any deferred tax on the Pillar 2 implications. And so the question would be, if you had a reporting date and you do not yet have the endorsement of the exception in your jurisdiction, what do you do when you have to report on that period end? I think, from our perspective, our current view is that entities would need to develop an accounting policy in the meantime, because you can't yet say that I'm applying an exception that hasn't yet been endorsed. So, but in that policy, I think where we are at least is that it might be acceptable for an entity to conclude that the Pillar 2 legislation does not result in additional deferred tax balances needing to be recognized. This is not us saying we didn't need the exception to begin with. I think this is just saying there's a lot of uncertainty, and as a result, entities will need to recognize or at least develop an accounting policy that talks about how they consider whether or not they should recognize deferred tax. And I think on the slide there, we've got aspects that we think folks may consider in coming to that policy is that there's a lack of clarity on how you actually and whether or not you should recognize deferred tax. The FASB in the US recently released some interpretative guidance, which, although completely aligned with IFRS, also helps provide some explanation as to how one might say you shouldn't book deferred tax. An entity should also consider the informational value of the number, which, as I mentioned before, we in many cases think will not be very helpful. And also the fact that you are pretty comfortable that there will be an upcoming amendment to IS-12. It's just that it hasn't yet been endorsed. And I think taking all of that into the round, I think entities would have a fair chance of developing an accounting policy that clarified that they are not recognizing deferred tax at this point in time. Clearly, a big thing that's very important for entities to consider is what their local regulators' view may be on whatever accounting policy they develop, if they need to do so as a result of the delays in endorsement. Right, so staying with taxes, but changing tack slightly and talking a little bit about energy windfall taxes. So folks will be aware, as am I, that energy prices have gone up if you just look at your electricity bill for the end of the month. And as a result, many regimes or jurisdictions have implemented new requirements that tax additional profits or the extra profit that energy companies are making. And from an accounting perspective, it makes a difference whether or not you believe that additional amount that you have to pay as an energy company, whether or not you believe that is a tax in the scope of IS-12, or whether or not you believe that is a cost and it would be a liability in the scope of IS-37. Now, why is that important? So on the slide, we've got several reasons why it would be important. The one is that if EBITDA is a key metric for a company, it will make a difference. So folks may recall EBITDA stands for earnings before interest, tax, depreciation, and amortization. And it's the T in there that's important. So if you think that this additional payment is a tax, then clearly it would go below the EBITDA line. So your EBITDA number would be relatively higher. If you believe that it is not a tax and it's just an operating cost, it would reduce your EBITDA. So it makes a difference if EBITDA is a key metric for a company that is impacted. The other issue obviously is deferred tax. So if you believe that it is a tax, you also then need to look to see whether or not there'd be future tax implications as a result of the incremental payment and whether or not that generates or adjusts any deferred tax balances. And obviously from a financial statement presentation and disclosure perspective, is it sitting in an OPEX amount? Is it sitting in the tax line? Is it sitting in the tax liability? Or is it sitting in a general provision liability as well? So again, there may even be issues around recognition in an interim period if something is a levy, for example, in the scope of IS-37 versus whether or not it is a tax in the scope of IS-12. So a lot of different things that might arise depending on whether or not you think it's a tax or not a tax. And let's get on to some of the things you may want to think about in making that judgment. So on the slide here, we've got two examples, largely based on some of the new tax requirements in the EU from an EU directive perspective. And one is called the solidarity contribution And the key feature of that is that it represents the excess of your current taxable period's profit above a certain threshold, but it's still based on your taxable profit for the year. And in many cases, that will continue to be in the scope of IAS 12 as a tax because it's still calculated on your actual taxable profit amount. It's just the threshold at which it kicks in is dependent on your historical taxable earnings relative to what you've earned in the current period. Then you get more tricky ones, which are sometimes called revenue caps, and in other regimes, they're based on adjusted revenues. And in some cases, the payment is triggered when the price exceeds a certain value in local currency, in euro per unit of electricity provided. And again, we've got some countries there that have been impacted. You'll note the UK is there, so it's not just in the EU. A lot of regimes are implementing something similar to this. And that one, in many cases, can be a lot more tricky in terms of whether or not it's in the scope of IAS 12 or IAS 37. Why is that the case? Well, it's because, unfortunately, from an IFRS perspective, we don't have a huge amount of guidance on differentiating a tax from a non-tax. And so there was an IFRIC agenda decision several years ago on tonnage taxes that we use most of the principles to try and make that judgment. And two of the key things that folks should be thinking about here is whether or not the amount that you're taxed on is based on a net notion or a net amount, because that was quite important when the IFRIC looked at their agenda decision. So to the extent your revenue cap starts deducting expenses and it starts going to more and more of a net notion like a taxable profit, it's more likely that it'll be a tax in the scope of IAS 12. Another important feature is whether or not those deductions are actual expenses rather than notional expenses. So that was another key feature that the IFRIC looked at when they looked at their tonnage tax question that they got. But as I said, not a huge amount of guidance. And so I imagine judgment will need to be applied. I think, again, there it's also very important to understand from specialists in your jurisdiction, how are others viewing this type of tax or levy? And what is the regulator's view in that jurisdiction would also be an important aspect to take into account. So unfortunately, no silver bullet. I think judgment will need to be applied and you may need to consult with experts. Right, that brings us to the end of our Q1 2023 webcast. We hope you found that helpful, maybe even interesting. This slide here just lists all the resources that we mentioned today where you can find more information on the topics we discussed. And if you go to Viewpoint, which is our global site that includes all of our authoritative literature as well as thought leadership on all matters corporate reporting, you should find the topics we discussed today as well as additional information. Thanks very much.